Valens Research, Uniform Financial Analytics.
So if we look at JNJ, what we're seeing for JNJ is we're seeing a company that has strong returns and has a return trend that's been completely misrepresented by the as reported numbers. Right, again, if we're looking at these orange bars versus these blue bars. If you looked at JNJ over the last 3 years, and honestly over the last, call it 10 years, from 2009 on, you would see a company with declining, weakening returns, and you'd say, you know what this is? This is a mature, boring pharmaceutical and medical device company. This company isn't going anywhere. They're not innovating. They're not doing anything successfully. Quite frankly, this is a company that is likely to continue to be competed away by all of the biotechs and everything that's entering the space. Literally in the last 3 years, you'd look at it and you'd think, okay, fundamental trends are actually down. I shouldn't even waste my time on the business. But then you might wonder, if the fundamentals are falling, why was the stock outperforming the market? Just for context, there's one chart that I haven't described yet in the 5-panel chart that we have here. We've already talked about return on assets. We've already talked about asset growth, right? How you compound the business. We've already talked about our adjusted price to book and our price to book metric, and we've talked about our as reported versus adjusted PE. This last chart is the TSR, the total shareholder return of the company relative to the market, which is why we have that second R. What is total shareholder return? Total shareholder return is the total stock price appreciation and dividend income that you get from a company annually. And we look at it relative to the market, that second R, because of the fact that we want to understand, is the company outperforming or underperforming the market? Because that's what helps us understand what the trends are for the business. And what we can see is when you see this sloping up, like from a 1 to 1.1, or here in 2007 to 2008, from 1.1 to 1.6, that's because the company outperformed the market. When it comes down like this, right, dropping from 1.6 to 1.3, that means the company underperformed the market. When it's flat, like from 2003 to 2004, that means the company performed in line with the market. Right, we can see as J&J had strong returns that were stable and also is growing, it slightly outperformed the market from 2003 to 2007. Now, from 2007 to 2008, J&J wasn't up massively. The reason why it rose because the market fell and J&J fell a lot less. But what was really important, right, this is what's significant, and we can see this looking at the uniform accounting numbers, but we can't see it looking at the as reported numbers, is as returns started to fall in 2008, 9, 10, TSR fell, right? The market recognized that the real returns of this business are falling. But what was important in 2011 to 2013, returns started to stabilize and improve, and J&J started to invest again. What happened? The stock started to appreciate relative to the market. And over the last couple of years, well, as reported metrics have been telling you that returns have still been declining for J&J, uniform accounting metrics have been in an upslope. And guess what's happened? The stock has reacted to the uniform accounting numbers, not the distorted as reported metric. You look at J&J on an as reported basis, you think it's declining. It's not. Returns have actually improved from 17% to 21% in the last couple of years, and are forecasted to maintain at those levels. Right? The market, thinking J&J is declining, is pricing a continual decline. But what do we think J&J would be worth if we just saw returns plateau at current levels? Right? So returns just plateau at 20%. What's the stock worth? With modest growth, as the company has been doing. The company's got 16% upside. Now, if the trend in improved returns continues and it gets up to, let's say, 24%, what its legacy returns were, right, then we're looking at a company that's 40% upside. You wouldn't know to possibly modeling this kind of scenario, though, if you were looking at the as-reported metrics. Why? They are directionally wrong with the trend in profitability for J&J over the last 10 years. You're getting bad data on the as-reported metrics.
Valens Research, the world's leading source for uniform financial analytics.